All right, let's jump right into this explainer. Today, we're popping the hood on Diversified Energy Company, drawing directly from their 2025 and 2026 reports. Now, if you follow energy markets, you already know the industry is constantly shifting. But Diversified, they've carved out a highly specific, very deliberate lane for themselves. We're going to break down their financial and operational engine and figure out exactly how they are pulling this off. To really understand this company, you have to hear this quote from their CEO in the 2025 Sustainability Report. It perfectly sets the stage for our entire analysis. They are committed to stepping up when others step away from the challenge of owning and operating established assets. Think about that for a second. They aren't acting as wildcat explorers out there drilling high-risk, unproven wells. Not at all. Their whole business model is built on acquiring mature, established assets, stepping in when other operators want out. It's a strategy completely rooted in solutions-oriented stewardship and generating highly reliable free cash flow. So, here is our roadmap for today. We'll start with Section 1, the Diversified Energy Footprint. Then Section 2, 2025 Financial Performance. Section 3, Managing Risk with Hedging. Section 4, 2026 Growth and Acquisitions. And finally, Section 5, Returning Shareholder Value. Let's get to it. Okay, Section 1, the Diversified Energy Footprint. Let's start with where they actually operate. Their geographic reality spans a massive 14 states across core U.S. basins. They have a very heavy presence in the Appalachian region, so we're talking Pennsylvania, Ohio, and West Virginia. But they don't stop there. They reach deep into the central U.S., covering the Permian Basin, the Haynesville and Cotton Valley formations, and the Western Anadarko Basin in Oklahoma. So they aren't just localized to one small pocket. This is a highly diversified, geographically robust machine. And all that footprint translates directly into this staggering number: 1,086 million cubic feet equivalent per day. That massive figure represents their net daily energy production for the year ending December 31st, 2025. It's an enormous amount of energy being responsibly produced, driven by a workforce of nearly 2,000 employees across those 14 states. And all of this operational scale, it culminated in an impressive $1.6 billion in total revenue for 2025.
Moving on to Section 2, 2025 Financial Performance.
With that physical scale established, let's see how it translates to the balance sheet. They're sitting on a massive 6,082 billion cubic feet equivalent in estimated proved reserves. But here is the absolutely crucial detail. 94% of those reserves are already proved and developed. Just 6% is undeveloped. This means the vast majority of their assets are already producing. They are ready to generate cash right now without requiring the massive, high-risk capital expenditures you'd need to build out new infrastructure from scratch. So what exactly are they pulling out of the ground? Looking closely at their product mix, you can clearly see what's driving the ship. Their reserves are overwhelmingly weighted toward natural gas. It makes up over 4.4 million cubic feet. That's roughly 73% of their total reserves. While they do have a significant amount of liquids and oil, make no mistake, Diversified is primarily a natural gas powerhouse. That brings us to Section 3, Managing Risk with Hedging. Producing energy comes with a major catch, right? Commodity prices are notoriously volatile. They're a roller coaster. So we have to ask, how does Diversified protect its $1.6 billion in revenue from a sudden price crash? The answer is highly disciplined derivative hedging. They use these financial contracts to lock in their prices on the vast majority of their production. By the end of 2025, they had fixed the per-unit sales prices for approximately 80% of their production over the next 12 months. By doing this, they are essentially building a financial fortress around their expected income. They gladly trade away the wild, unpredictable highs to entirely eliminate the devastating lows. It's all about prioritizing reliable free cash flow. Let's look at the real-world results of that strategy. If Diversified had just sold their product at volatile market prices in 2025, meaning excluding their hedges, they would have realized an average price of $3.88 per thousand cubic feet equivalent. But because they actively managed their risk, their realized price actually bumped up to $3.94. This hedging strategy didn't just give them absolute revenue certainty, it literally added value directly to their bottom line. Let's dive into Section 4, 2026 Growth and Acquisitions. Moving from 2025 into early 2026, the company absolutely didn't just sit back and relax. In the first quarter, they went on a highly strategic expansion spree. They successfully closed the Sheridan acquisition in late April, which immediately added 62 million cubic feet equivalent per day of production right next to their existing East Texas assets. Plus, they expanded their non-operated portfolio by partnering with leading operators, folks like Mewbourne in the Anadarko Basin and Continental Resources in the Permian Basin. This beautifully positions them to capture upside from profitable new wells while leaning on the operational expertise of their partners. But the true crown jewel of early 2026, that has to be their joint acquisition of Camino Natural Resources in Oklahoma. This is a massive $1.175 billion deal. And what makes it so fascinating isn't just the sheer size, it's exactly how they are paying for it. They are utilizing an incredibly innovative, off-balance sheet partnership with the global investment firm, the Carlyle Group. Let's break down why this structure is such a game changer. Through this special purpose vehicle, or SPV for short, Diversified is contributing only about 20% of the financial consideration for the deal. Despite that incredibly low initial cost, they secure 40% of the residual cash flow from the SPV. The debt stays entirely off Diversified's balance sheet. And here's the kicker. Diversified retains 100% of the undeveloped acreage upside. So they get immediate cash flow, total future upside, and minimal financial risk. Honestly, it's an absolute masterclass in capital efficiency. Finally, Section 5, Returning Shareholder Value. So what does this highly structured cash-generating machine actually mean for the folks holding the stock? Well, it means the company is aggressively and continuously buying back its own shares. Over the course of 2025, they repurchased 5.68 million shares. Then, in just the first quarter of 2026, they bought back another 5.03 million shares. That's about 7% of the total shares outstanding. And they didn't stop there. Records show that right into July 2026, they were still in the market, snapping up nearly 290,000 shares in a single day at an average price of $13.68. They are methodically retiring millions of shares month after month. And that brings us to this incredible number, $94 million. That is the total amount of capital returned to shareholders in just the first quarter of 2026 alone. This included $72 million in share repurchases, which was facilitated in part by the full exit of a former primary owner. This proves their absolute commitment to not just generating free cash flow, but putting it directly to work, optimizing their portfolio and seriously rewarding their investors. By stepping up when others step away, Diversified has built an incredible cash flow engine. They've proven that buying mature, predictable assets, strictly hedging the risk, and utilizing brilliant financial structures, like that partnership with Carlyle, can yield massive, reliable returns. It really leaves us to wonder, as global energy demands continue to shift, which assets will they target next? And is this the exact blueprint that other energy consolidators are going to be forced to follow? Thank you for walking through this explainer with me today. This is certainly a strategy worth watching very closely.